Hey everybody, JJ here. You're watching Bull Boom Bear Bust. It is Tuesday, December 28th, 2021. We've got a lot, as usual, a lot of financial economic news to get into today. There's some debates happening on social media. Some people saying this is the greatest economy ever. Other people saying no way. Things are getting worse for most people. Well, let's get into some numbers and let's kind of talk about what everybody else has been looking at and going back and forth on here. And let's start right here. Mark Gongloff tweeted out the following. It's amazing how negative the president's economic coverage has been, considering the economy improved more in his first year than it did in any other president's first year going back 50 years. And this is out of Bloomberg. And this shows you the GDP growth. And we see it stands at about 5.5%. And we look back at previous presidencies, and compared to previous presidencies, it's pretty good. But most of you should know by now, what is GDP? It's mostly consumption, spending, and people going into debt. So when people go into more debt and spend more, consume more, that makes the GDP number look good. So what do you need to do to have a nice GDP number like we're seeing right now? Well, you need rising prices, inflation. That helps because when people have to pay more, that's more spending, and that's better for the GDP. Less bank regulation, therefore more loans, more spending, more borrowing, and that creates more economic growth because it's a consumer-based economy. So the more debt that's issued, yes, the better the GDP is going to look. Rising prices and asset bubbles. When home prices go up, people can borrow against their homes. They can take out more equity loans, and more people can go spend money, take more vacations, buy cars with the money that they borrowed from their equity in their home. And that's also going to make GDP look better because that's more spending in the economy. So simply put, yes, the more debt that's issued, the better the GDP's going to look. It's pretty simple. For example, if it were not for the 30 trillion in debt that we're almost at now as a nation, if that would have never been accumulated, if we didn't have an endless debt ceiling, GDP would have crashed many, many decades ago. So the more you spend, the more debt you can accumulate as a country, then that's going to make these economic numbers look good. But the question should be, is the average American, is the average working person, the average middle class, working class individual, are they feeling the benefits of this GDP growth? Well, when you have asset bubbles and when the economy is hyperinflating, sure, there's some people that are going to benefit. Just ask the homeowner that took out home equity and now they're taking vacations, they're buying vehicles, with their home equity. Their life is pretty good. In the background, they're mounting up more debt, but they may look like they're doing better and they may feel like they're doing better. And the economy looks like it's doing okay because those people are spending money. But should we look at the economy just as a number, or should we look at it as how the average working person is doing? And guess what's going to happen? The average working person is going to end up paying more and more and more, not just in rising prices, but they're going to come after the working person, trying to get a bigger portion of your paycheck to pay for all this debt and spending. It doesn't matter that they created these debt notes out of thin air, these digital notes, these digital debt notes. It doesn't matter that they were created at the click of a mouse, at the push of a button. You're still going to be the one to pay for it in the end if you're a working person. And I should expand on that. Even if you're not a working person, if you're someone on a fixed income, do you think your monthly Social Security checks are going to keep up with the rising cost of living and the rising prices? Please let me know what you think down in comments about that. Next, let's talk about home prices. Now, let's put a positive spin on this. People like to say I'm negative, I'm doom and gloom. Any piece of news can be spun to make it into a positive. So, for example, rising home prices. If you're someone that's selling your home, if you're someone that's borrowing against your home equity, that's good news. You can borrow more money because you have more equity. You could sell the home for more because it's higher in price. But on the flip side, if you're someone looking to buy a home and you're priced out of the market, then rising prices are not so good. So people say that this is negative news. It depends on what side of the fence you're on. Are you a buyer, or are you an owner, or are you someone that's looking to buy? So depending on which side you're on, it can be looked at as positive or negative. Recent article out of CNBC, home prices surge 18.4% in October. Now this is the Case-Shiller 20-city index, so it's a couple month lag when we get these numbers. But when you compare it to the month before, the home price gains decelerated slightly, because the month before, which was September, the year-over-year increase for that month was 19.1%. So home prices didn't go up as much, but they're still up very big. And when it comes to home prices, we have to talk about this again, because people have argued with me or disagreed with me for years on this. Back in 2017, 18, when I first started talking about how home prices now are higher than what they were before the housing bubble, people in comments disagreed. No, JJ, this is the peak of the housing bubble. Home prices are going to crash. Here we are, 4 years, I believe, almost 4 years since I started this channel. Home prices are still rising. They're going to continue to rise. Let me know down in comments if you disagree. Why are they going to continue to rise? Because banks are not being held to the typical standards which they should be held for. They shouldn't be able to loan out this much money when they don't have enough capital and reserves to cover these loan losses, if there are loan losses. They don't have enough to cover all the debt that's being issued. So as long as no new restrictions are put on the banks, on the lending institutions, home prices can continue to climb, because banks are not going to be restricted. They can continue to loan out bigger and bigger amounts of money, bigger mortgages. There's no limit right now. It's kind of like the debt ceiling. There's no limit on how much debt can be accumulated and how much debt can be issued via loans and mortgages. All right, I know this sounds crazy. This is a lot to absorb for the average person, but this is the way that things work right now. If someone comes in and passes laws and changes the way the banks are allowed to loan out money, then you'll see a reversal of this. Just like in 2008, we saw the banks, they froze up the lending. They stopped lending. They became very careful about the mortgages that they gave out, about the lending. It was really tough to get a big loan back then, a big mortgage. But in the 12 years since then, the 12 plus years now, lending has again loosened, and now we're way worse than we were back then. We don't have all the same types of loans. Like, we don't have the equity or the interest-only loans. We don't have the adjustable rate mortgages like we did back then. But as far as the amounts of debt that's issued, the amount of the loans is actually a lot bigger now and a lot worse than what it was back then. And it has to be, because home prices are so much higher. So that's the only way to keep this bubble inflated, is to let the banks continue to loan out bigger and bigger loans and never ending debt. All right, so on the flip side, you have to put this out there. This could be changed. This could all be reversed at the stroke of a pen. It only takes a lawmaker to come in and say banks are no longer allowed to do that. Then the bubble will burst. It's all up to the lawmakers. It's all up to the people that are in power right now. It's all up to the individuals that are steering this economy. And that's the bottom line. So yes, again, we have to address this. So when you have the debt machine running at full speed, when you're creating monstrous, enormous amounts of debt, of course the GDP number is going to look good. But is a high GDP number, does it mean that the average working person is doing better? Usually not. So if you're not in the top 1%, if you're the average working person or someone else on a fixed income, get ready, because 2022 is going to be very, very difficult. And these people that are not investing to try to compensate or to try to beat this rising cost of living, these rising prices, I'm not sure how they're getting by. Maybe they already had a whole bunch of money saved up. Myself, I have to continually look for investment opportunities to try to just make it, to try to stay afloat here. And what I mean by that is continuing to look for assets that are going to go up with these markets. Ride the bull. Like we always like to say, ride the bull, prepare for the bear in case there is some sort of plug that gets pulled on this money machine. Until then, keep stacking. Stay well, stay safe, everybody. Thank you so much for being here. Big love. Bye for now. Peace.